Alright, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we've got a very interesting episode to cover, full of a lot of concepts and content. So, we're going to be talking about how to pick stocks, but more importantly, we're just going to be running through my mindset in terms of how to understand, from my perspective, whether a company is worth buying and what are some of the things that I look for when deciding whether to go long. Okay, so we're specifically talking about going long. Going short is a completely different concept in itself, so we'll cover that at a later stage. But more specifically, we're talking about going long. So buying stocks, holding it, waiting until it gets to the value or your desired value, and then I guess selling it off when it gets to fair value. Now, the reason why I wanted to make this video was because I had a few comments on my channel. So shout out to Robert, Lambs, Kui, and some of my other subscribers. Okay, so I got asked some interesting questions. Some questions on, hey, look, are you still holding GraphTech? What are your thoughts on HMI, or what are your thoughts on Guangshen Railways? Can you do a video on BEST and compare it with ZTO? So I thought I'd take this video and this opportunity to answer all of these questions and then just give you guys a bit more, I guess, insight into my thought process when I look for stocks to go long on. Okay, so these are all really, really good questions. So the topics for today that we're going to cover. Okay, so first of all, I just wanted to get something straight, is that I don't consider myself a value investor, and what I'll do is I'll expand on that a little bit more as we progress into the video. So my investment time horizon is 6 to 18 months, okay? So that's not to say that I don't have long-term stocks, because I do hold stocks like Auckland Airport, where I believe that they will do very, very well over the next 20, 30 years, and hence why I hold them. But the majority of the stocks that I invest in, I'm targeting 30 to 40% a year. So what I want is, I want these companies that have the ability to give me 30 to 40% per year, but not to hold them for life, okay? I'm talking 30 to 40% return in the next 6 to 18 months. Get the return, get in, get out, move on to the next company that'll give me that 30 to 40%, and then that's how I plan to compound, okay? So it's very, very different to a traditional value investing mindset. And so I'll cover the reasons why I think like this, okay? But, one of the people that really inspires me is 50 Cent, okay? So the reason why is because the way that he goes about making money and doing business, it's very entrepreneurial, okay? And so when I invest, this is actually the mindset that drives me, is to look at things in a very, very different way to what other people are looking at, okay? So not talking about ratios or, projecting cash flows, but actually looking at the business and the investment in a very different mindset. So we'll cover that very shortly in the video, okay, guys? And the reason why my investment horizon is 6 to 18 months, looking at, 30 to 40% as soon as I get that and get out. Well, look, the answer is really simple, okay? I would rather enjoy my money when I'm young rather than when I'm old, okay? And that's not to say, somebody like Hugh Hefner wasn't enjoying his life. He was enjoying it all the way till 97 to the grave, okay? But I would much rather prefer to, enjoy my money. So right now I'm sort of 30, right? So much rather prefer enjoying it when I'm, mid 40s, early 50s, rather than sort of holding forever like somebody like Buffett, who's now almost 90, or Charlie Munger, who's pretty much in a wheelchair. I mean, they've got all the money to burn, but how much of it can they really enjoy, okay, guys? And so I always think about this. You can never take your money with you to the grave. So as a result, what's the best way to get your desired returns to at a time that you can then still enjoy it after for some time to come, okay? So these are my thoughts. Now, I would say that my investment mindset is probably the closest to Peter Lynch, okay? So he's by far my favorite investor, and I think he's actually the best investor of all time, so even better than the likes of Buffett or Klarman or Graham, and that's a pretty big call. And the reason why I really enjoy Lynch is because he's not afraid to lose, but he always makes sure that he wins a lot more than he loses. And when he wins big, okay? And I think that's the sort of entrepreneurial spirit and the balls of steel that somebody like Lynch has, because he has had a share of losses. But overall, he has won a lot more than he lost, okay? And I think the key difference as to why he's such a great investor is because he thinks like an entrepreneur, not like a value investor, right? If you really read his books, look at his investing style, follow his investments, you'll realize why I'm so interested in his investing style, okay, guys? And so that's just to sort of clarify my investing mindset. But having said that, I am not a speculator, okay? Um, I do just as much, if not more research than some of the most deep researching value investors out there, okay? And a really good saying that sums it up is George Soros, fantastic, billionaire investor, very smart guy, very entrepreneurial guy, and just a really good businessman, okay? And what he says is basically in the effect that if you're having fun, you're probably lighting your money on fire, okay? Because investing is painstaking hard work. And so that's the difference between speculating and investing, okay? Just because I don't invest in the traditional value investing way doesn't mean I'm a speculator, okay? And if you're having fun when you're investing, you'll probably have a lot more fun lighting your money on fire in Vegas, because uh, the amount of research and reading that I still do, despite myself not calling myself as a value investor, is absolutely painstaking, okay? So I work full time, then I come home, and then I work some more. So I'm kind of doing the Jack Ma sort of 996, okay? So work from 9 to 5 in the morning, come home, and then work till 9 p.m., go to sleep, and then repeat that, and then do that 6 days a week, all right? Now, guys, just remember, none of this is investing advice. And so before you buy anything, you should always talk to a professional, and you should always do your own research. Okay, guys? So none of this is, a recommendation to buy any stocks. This is just my mindset and how I like to invest. Okay, all right, guys. So let's get into it. So what I'll do today, guys, is I'm going to run you through my thought process, and we're going to use 5 stocks to illustrate how I think about going about my investments, okay? So we're going to look at Best Logistics, ADT Security, Weight Watchers, 2U, and Evolent Health. And 2 of these stocks I've said no to, which is Best and ADT. One of these stocks I've said yes to, hence I've initiated a long position, and I'm looking to get out, like I said, probably in the next 12 months based on how things are going with Weight Watchers. And then currently work in progress is 2U and Evolent Health, okay? And guys, just a little note, if you're enjoying my videos and you're really getting value from these videos and you're learning something, share the love and leave a like, drop a comment, and subscribe. It really helps the channel grow, and it really helps me to bring more of these videos and good content for you. Okay, so let's get into it, guys. So first of all, my criteria for picking stocks in terms of going long, okay? First of all, they have to be down at least 60 to 70% in the last 12 months and are currently technically oversold, okay? So technicals play quite a big role in how I decide what to invest in and when to invest in terms of technical analysis. And the reason being is because when the sentiment in something is absolutely abysmal, that's when you get the best returns, okay? So I don't know if you guys seen the emotional stock market emotional curve, but at the very bottom, when there's capitulation, that's the point of maximum financial return. And that's why it has to be down 60 to 70% and be technically oversold. Furthermore, the company has to be doing well, okay? In terms of doing well, it could be that the revenues are going upwards. It could be the revenue and earnings going upwards. It could be maybe the revenue going like this, but the earnings going like that consistently. It could be that other metrics, maybe it's their subscriber base, maybe it's their retention rates. It really depends on the company. So the industry and the economics, both the micro and the macro, has to support it. And the catalyst will be then in the next 1 to 5 earnings calls, they're going to go, oh, well, actually, things weren't that bad, right? So people are going to look at it and they're going to go, they sold it off and panicked. And then they're going to go, oh, well, actually, things aren't that bad. Well, let's buy back in, okay? So then Mr. Market will go, oh, maybe I was overreacting. And so they're going to bid the stock back up. And that's called mean reversion. And so, like I said, that's why we have to buy at the very, very bottom, because then when things, even if things aren't great but are just not that bad, the thing will still go up, okay? And that's the sort of thought process. That's the long criteria of my investing style. So let's have a look at best logistics and 2U, okay? So let's first have a look at why I was interested in them, but then after further research, why it didn't support a long position. So as you guys can see, both these stocks are way down in the last 12 months, more than 60, 70%, even in some cases 75, almost 80%. However, if you look at their trajectory, you'll see, oh, well, hang on a second. Well, I mean, revenue's going way, way up. Losses seem to be getting less in terms of best logistics, but in terms of ADT, it sort of fluctuates, right? So I thought, okay, well, let me have a look at that, right? Because if the business isn't doing well, they wouldn't be winning a lot of business. So let's have a look at why I was interested in it, but then didn't end up meeting my criteria. Okay, so I'm going to summarize this in a few short sentences. So first of all, Best is a logistics player in China. But if you know the logistics industry, you'll know that it's a very, very competitive, fiercely competitive industry. And even with a 7% backing by Alibaba, they may not even go profitable. And based on my research, I don't actually have that catalyst, right? Because the reason why the stock was being bid down was that, like, oh, guys, we're winning market share and we're growing our revenues. But what drove the stock down was their inability to turn profitable. And if you look at their stock from all the way back in 2014, now it's almost 2020, 6 years later, and they're still like almost profitable. But the question is when, right? And after I did my really deep research, I couldn't understand that, and that's why I didn't initiate a position. Okay, now let's talk about ADT. In short, I believe ADT is a lipstick on a pig bag of worms, okay? So I think the management has dressed this company up to try and fool investors to think it's a tech company. However, if we dig deeper, it's definitely not, okay? Now, just remember, Apollo bought them and took them private, but then took them back public because they couldn't fix the company, and now they've loaded up on so much debt that they're hoping investors would be fooled into buying some of these shares and then helping them pay off debt, okay? But at the end of the day, their go-to-market strategy is flawed, and that's why I didn't initiate a position in this. So let's do a bit of a deeper dive to understand how I came to this conclusion, okay? So let's start off with Best Logistics. Now, what I've done is I've now put together in a spreadsheet their last sort of, 6, 7 quarters of numbers. And if you guys are interested, you can do a little bit more digging back, 2016, 2015, 2014. And you'll see, okay, great, look, gross margins are going up, revenues are going up. However, if we focus on where my mouse is, you'll see that they can't quite seem to, it's like, hey, cool, our net margins are nearly positive, and then, it goes way, way negative. And the reason being is, like I said, the logistics industry is fiercely competitive in China, okay? And I just don't see how they're going to go, positive in terms of profit. I just can't see that. I can't see that happening. And guys, if you're interested to see how I understood this, I would encourage you to go back and have a look at all of their earnings quarterlies and as where and when they reported on market share, okay? And you'll see that the market share hasn't really increased that much. It's been sort of fluctuating between 9 to 10%, and it hasn't really been able to break that sort of 11% barrier, okay? And furthermore, their customers are asking more of them in order to just stay competitive. So the amount of investment that they have to make in order to just stay in the game and compete with the likes of ZTO, Express, and others, it's just going to really make them hemorrhage in terms of their net margins, okay? Because logistics is a very low margin game, and so even if they're driving a lot of these efficiencies, I don't see when they're going to turn profitable. So that's the reason why I passed. Okay, so guys, Now let's look at ADT. So ADT Security, they were public, they were taken private by Apollo. Apollo couldn't fix the business, so Apollo took it back public, okay guys? And so they were going to spend 100% of their IPO proceeds trying to pay off debt in the business, okay? So this makes me think, if a company cannot fix a problem as a private company, what will change as a public company? And why would going public all of a sudden fix their problems? And the answer is it won't, okay? So that's the first red flag. Secondly, they're going, no, we're a technology company now. We're expanding on our relationship with Amazon, and this thing is going to, you know, make us go to the freaking moon, right? Well, actually, that's not right, because if you dig through the earnings calls, and it took me almost 20 hours of digging to find this one comment, okay, which is the CFO has said, look, at the end of the day, you know, the Amazon thing, yeah, we'll call it a partnership, but at the end of the day, what it is it's just another sales and marketing channel for us, okay? And what this shows is that uh, they need Amazon a lot more than Amazon needs them, and the reason being is because their biggest competitor, Simply Safe and DIY Home Security, they also partner with Amazon. Look, everybody partners with Amazon, okay? And what they're trying to do is they're trying to address this thing, which is not a partnership, okay? It's basically a sales and marketing channel agreement, okay? It's basically a channel agreement, and then they get a bit of kickback, whatever they sell through Amazon. They've tried to blow this up to massive proportions to fool investors, but at the end of the day, you know, it's not a partnership, okay? Further evidence is that Amazon has spent $1 billion acquiring their own smart, you know, DIY as a service home security thing. So why would Amazon partner with ADT and then spend $1 billion? None of this makes sense. And the reason being is because, you know, again, the management's trying to pull the wool over our eyes, okay? And so that's the other reason. And furthermore, they made an acquisition called Red Hawk, okay? And they're saying, look, this thing's going to be great. It's going to drive our commercial sales. It's going to, you know, it's going to create a lot of value for us. But then they're like, oh, look, we're just still trying to determine how we're going to integrate the business with the rest of the commercial business. And I'm like, what? So you made this big acquisition that's going to turn your company around, and yet you don't even know the go-to-market strategy and how to integrate, right? And again, that just shows poor management. And then finally, guys, look, they've said, look, we acquired this other business. It's called Life Shield, okay? And we really, really like the management, the people. So we acquired the company for the people, but we don't have a lot of information to share on the go-to-market strategy, which is highlighted in orange over here. And we're still in the process of working through our launch plan and testing it. And I'm like, man, it's like, shouldn't you guys have done all of this before you made the acquisition? I mean, you seem like you're betting quite heavily into this company, and yet you don't even know how the strategy is going to integrate, okay? So all of this points to poor management. And taking a company from private to public is not going to change that, okay? And that's the reason why I didn't initiate a position on ADT. And let me tell you guys, it took me almost 30 hours of reading just to find these 6 paragraphs of information to then show you, okay? So that just shows the extent that you have to go if you want to, you know, understand the company that you're investing in, okay? So this is not all fun games and rainbows and whatnot, right? Okay, guys, moving on. So, Weight Watchers. Why did Weight Watchers meet my criteria, and why did I initiate a long position on Weight Watchers, okay, guys? And just to show you guys that I'm not BSing you, here's a screenshot of my Weight Watchers position, which is up about 30-odd% in a couple of months, okay? So, did it meet the criteria? Yep, it fell from about $100 down to about $18. Massive. But then, hang on a second, revenue is going up, earnings is going up, everything's going up. So why did it drop, okay? And this, so let's now explain why I initiated a position, and I'm still holding. So first of all, as per what we covered earlier, the sentiment was absolutely abysmal, okay? However, the company fell to the prices where they were at in early 2017, but yet the company is in a much healthier shape, okay? And so the company's parabolic rise was actually misunderstood, because their record 2018 earnings per share, they had a lot of one-time benefits, okay? But the market obviously wasn't seeing that. They were just like, oh, EPS is going up, let's buy the freaking company, and oh, what happened to their EPS? Oh, it's gonna die, right? And so as a result, when they had their massive fall, it was like, oh no, it's your mom's weight loss program, and it's becoming irrelevant. And the keto diet, excuse me, the keto diet's going to be the end of them, right? And all of this, but at the end of the day, despite all this negativity, the company continued to maintain and grow their subscribers, okay? And it was record subscriber numbers. And if you really do some digging, you'll understand Weight Watchers is not a weight loss business, it's a subscription business, okay? The more mind share that they have of something, the more market share that they have, okay? So Weight Watchers is a play on mind share and not weight loss programs, okay? And just remember that. And that's what the market misunderstood, because um, back in 2019, late 2018, early 2019, they rebranded from Weight Watchers to WW, and quite frankly, the VP of USA, the VP of the USA business basically fucked up the execution, okay? And she said, oh, look, we're not going to need to market or advertise us, okay? Because people want to be part of this whole wellness thing, okay? And that's where the fuck up was, okay? And so, they still had to associate their brand to weight management. You can't just go from Weight Watchers to WW like that. So what happened was they fired the VP, they fixed the execution problems, and they continue to have record subscribers, okay? Now, people will say, well, hang on, but their in-person programs are falling. And okay, yeah, it is falling because they were focusing on fixing their digital programs because the margin is about 1,000,000 times higher, and that's going to drive their APS, right? And so once they fixed their online, their sort of app, and now they got the digital engagement, now they can slowly convert their sort of digital users back into the in-program studio users, okay? But the market's saying, no, they're going to become a 100% digital company. And again, that's not true. The reason why they were thinking that is because they didn't do their research, okay, guys? So now just to give you some more insight, okay, so they've got Oprah fronting it. They've got DJ Khaled, Robbie Williams, Kate Hudson, okay? They've got all of these people. First of all, they were fronting the app. Now the app is solid. Retention rates are fantastic. People are engaged. Now they're going to slowly try and revamp their studio business. And early signs of testing and refinement already reinforce the fact that this business is still going to do well in the next sort of, 3, 4, 5 quarters, okay? They've had 2 EPS guidance upward revisions, and their web traffic is solid. So I don't actually see any reason to say that they're not going to do well, and hence I'm going to hold, because my sentiment is still more bullish than the market sentiment, okay? And so as long as that's the case, then I think that this is going to go up a little bit more. So guys, that's the reason why I'm still long Weight Watchers. And like I said earlier in the video, my time horizon for this, probably another 12, 14, 16, 18 months, something like that, and then I'll probably look at getting out, maybe earlier if it goes parabolic in terms of the share price. Alright guys, so finally let's conclude with my work in progress, okay? Let's conclude with Evolent Health and TWOU. And this is where some of my subscribers might go, well, these companies don't even turn a profit, you're just speculating, okay guys? And let's put on our entrepreneur hats and think more like entrepreneurs rather than value investors, okay guys? Because if you're playing just on profit, you're missing out on a huge universe of stocks, and I'll cover that very shortly in terms of why, okay? But let's look at TWOU and Evolent Health. So both of these companies, share price has fallen off a cliff, revenue is going, way up, and if we focus on Evolent for a second, their losses are, getting more and more narrow, so they're very close to turning a profit, okay? And TWOU will cover that. It's sort of still work in progress, so I won't spend too much time on this, but let's start off with Evolent Health, okay? So this company serves basically people that provide Medicare and Medicaid services in the USA. Now, if you understand this market, which I'm still coming to grips with, you'll know that it's a massive market, okay? Now, there has been some massive reforms in terms of the Medicare and Medicaid system, and health providers, they were basically just reaming the system and getting billions and billions of dollars. That's not the case anymore. So there have been some reforms, okay? So basically what the government has said is they've said, look, guys, we're not going to just pay you in terms of how much you service guys, because you guys are just going to keep on reaming us. So what we're going to do is we're going to pay you a set monthly and annual fee, and that's all you guys have. So you guys are going to have to now, uh, you know, that's all we're going to pay you. So whether you make profit on that or not, it's not our problem. But we're also going to regulate you and make sure that you offer higher quality care, and make do with less money, basically. So as a result, health insurers and Medicare, Medicaid providers, they've basically shat their pants, and they've gone, well, what the hell are we going to do? We were running so inefficiently. This is our livelihood. And so this is where Evolent Health comes in, right? Because now we're talking about analytics. So they need to predict when a patient is going to get sick and for how long for, and the best course of action to get them better, which will get them to spend the least amount of money, okay? And we're talking like millions of data points to analyze these patients. So guys, this is very important, and this is huge, right? And this is why I'm interested in Evolent Health. And you'll see, if we have a look at it, that they were almost turning profitable, but then they had a massive tumble in terms of Q1 2019. And look, that's actually not a bad thing, because after I dug a lot more into this company, and if you do some digging, you'll actually realize what they're actually doing is that they're acquiring a lot more capabilities to then give them more data points, so that their AI, their data that they provide to health insurance providers smashes the competition. Okay, so what they're doing is they're actually investing in the ability to provide data points at a fraction of a second, right? So that people then can make quick decisions as to how to serve the patient and get the most out of that set budget, because they're not going to get any more than that. So then, they're going to have to use that as wisely as possible to profit. Okay, guys? And so, as you can see, their revenues are increasing, and yep, they had a bit of a loss expansion, but for good reason, because these were acquiring key components to make them more competitive in the long term. Okay, guys? And like I said, this is still work in progress, but just to sort of give you an understanding of why I'm interested in this company is I actually think the next 2, 3, 4, 5 earnings calls are going to be really good, and the market thinks are going to be really, really bad, okay? And as a result, that's going to send the share price upwards. And TWOU, I won't focus too much on that because it's still work in progress, but this is basically serving the online education market, which has about a total addressable market size of, for short courses and boot camps, about $300 billion, and then for actual online education, about $1.8 trillion, okay, guys? So this is massive, and they're only a $600 million company. But like I said, it's still work in progress, so I don't have anything too extensive to report yet. Alright guys, so this video, there's a lot of information, and there's a lot for you to digest, so let's quickly wrap up the video, as I don't want this to drag on too long, okay? So guys, now you guys at this point might be thinking, hang on, what about the PE ratio, or what about the price to book ratio, and you don't do a discounted cash flow? And then look guys, and again, let me just say, I'm not a value investor, okay? So these ratios mean very little to me. And the reason being is because if you confine yourselves to these traditional value investing metrics, which were, derived by Graham and Buffett 60, 70 years ago, you are going to miss out on a lot of stocks, okay? Because the way that you analyze tech companies, or, these sort of newer companies, you can't use price to book ratio, because you're talking about the mind share and market share um, of consumers, and you can't tangibly put that on a book value. It's impossible, right? So that's why you need to get really, really deep into the business and understand the business and do hundreds and hundreds of hours of research, okay? And guys, this is not the 2000s. Tech is not a bubble. Look around you, okay? Look at everything that's integrated with tech. Look at how big data analytics and business intelligence has grown in the last 5 to 10 years. Just look around you guys, okay? And I think if we, as investors, only focus on the current ratio, or whatever, blimmin' value ratio, we are doing this, and we are limiting ourselves, and we're missing out on this, okay? So I think, again, if we go back to earlier in the video, really, guys, think like an entrepreneur, okay? And don't worry about these ratios. Actually trying to understand the business, right? And look, let's just use a couple of examples. China is shifting to manufacturing to services, okay? Lots of things that you can't put on book value. USA is predominantly services. If you fail to adapt your style of investing, or if you fail to adapt in any way, shape, or form in business, you become irrelevant. And the best example is Buffett knows this very well. That's why he pays the likes of Ted and Todd to go and buy companies that he doesn't understand, like Apple and Amazon, because he knows that you need to evolve to continue to be relevant, okay? And he might say things like, the discounted cash flow and, the ratios of the. But look, at the end of the day, guys, look at his actions, not his words. He spends 10 hours a day reading, reading, researching. That's all he does, okay? And what he buys is he buys the business and the industry, not the ratios, okay? And so the biggest misconception in investing, guys, is people think they look at a PE and PB ratio and they're buying the business. Again, that's not true. You are buying a ratio. Just like people who get excited about a company and doesn't research the company and then buys it, just looking at a ratio and buying it is the same thing. It's speculation. Okay, guys? So you really have to understand the business. How to understand if a stock is worth buying, okay? Because we've covered a lot today. The sentiment is abysmal. If the stock is down greater than 70%, but goes up 50%, it's still down about 50 odd percent, okay, guys? So just remember that. So I'm interested when the sentiment is abysmal, okay? Because at that point, even not bad news is good news, and it's going to send the stock up. Now, my catalyst for the business is after extensive research, okay? And just to recap, Weight Watchers, that was like 100 hours plus of research, okay? Saying no to ADT and Best was, again, 20 hours per stock to say no to, okay? After extensive research, my catalyst is the earnings calls. If I'm at least 85% confident that the management will have a good earnings call and the market thinks that they're going to have a bad earnings call, then I buy, okay? And so I let the earnings calls compound. And so my catalyst is the earnings calls. The earnings calls are going to send the stock up because I've done my research and I've understood the business and the industry that I know they're going to have a good earnings call. And as soon as the general market sentiment is more bullish than my own sentiment, I sell. And that's basically my investing mindset summarized in the video. So guys, really hope you enjoyed the video and hope that you got something from this and learned something useful. Now this is probably a bit more sort of out there and very different to how other people think. So, we'll see in sort of 5-6 years whether this is doing me well or doing me wrong. And until next time, guys, happy investing.